Welcome to the TrustleBridge Capital Market Observations Call. I'm your host, Eric Jefferson. Today is Monday, May the 6th, 2024. A lot to talk about. Before we get started, though, a few quick words from our legal team. With that, we can go ahead, dive right in. Want to first acknowledge been a very volatile period, a lot of data coming out. We'll talk through the three key components as well as their impact on capital markets. To quickly recap, though, S&P 500, a most widely accepted benchmark for stocks or equities, sits at positive 8% year to date. That is about 2% off its early April highs. Recall S&P jumped up nearly 10%. Then we had about half of that given back during some volatility throughout the month of April, has started to recover since, again, within 2% of its all-time highs. Bonds or fixed income struggling quite a bit, down 2% plus or minus. That's a function of a uptick in interest rate expectations that, at least at this point, have seemingly been calmed. I will talk through what exactly that means going forward. The three key pieces of data, though, we got in the month of April. First, inflation came in hotter than expected. Core PCE 3.7 versus 3.4. Again, that is going in the wrong direction, putting the 2% target that much further away. Again, we have seen some progress there, still a lot more work to do. Initially, when that data point came out, that had invoked some fears that interest rates would possibly have to go even higher in order to get us back to those long-term targets. Again, that is in sharp contrast. If we go back to January of this year, investors were forecasting 7 rate cuts. Now, those expectations have gradually been dwindled lower. Market pricing, maybe 1 or 2 for the balance of this year. But again, that has certainly been a 180 shift when we think about sentiment and outlook with respect to rates. Secondly, last month received a data point that the economy grew at a positive, albeit much slower rate than experts were forecasting. GDP came in at an annualized figure of 1.6. That is not only below the long-term average of 2, that was below the expectations of 2.5, and certainly well below the 3, 4, 5% that we've even achieved in really booming environments. That had in turn stoked some concerns around stagflation. That's slowing growth and higher prices. Don't believe we're in that environment. Again, this is 1 month's data point, but something that certainly knee-jerk reaction was felt in markets. Fortunately, though, as we do parse through the details, I think that headline number actually masked some underlying strength. Some of those declines due to inventories, which isn't unusual. The good news is we saw some really encouraging consumer data there. Consumers had gotten off to somewhat of a slower start to begin the year, but have seen momentum pick up. Again, we talk about the importance of the consumer in the economy. They make up 70% of domestic GDP. As long as consumers are willing to go out and spend, that in turn is what keeps our economy going. A third data point that actually, or ironically enough, led to this recent rally here to close out last week was some slightly softer than expected employment data. By that, payrolls were less than what forecasters were expecting. As well, we saw the unemployment rate tick up 0.1%, sits at 3.9. Again, still well below, the 5% target. But the good news is bad news. Takeaway there, or excuse me, bad news is good news. Where that did tick up ever so slightly, the market reacted to that, expecting the Fed, concerned about possible weakness or a slowing trend in employment. Investors believe that would give Fed more ammunition to cut, particularly in the face of what is still elevated inflation. That had a very positive reaction on markets. Finished the week higher, following again what had been roughly a 5-6% decline in the earlier weeks of April. Now, as we look ahead, we're about halfway through the earnings season. Again, that's where once a quarter we hear from corporate executives, talk about how their companies performed, the outlook going forward. So far, results better than expected. Companies, as we've talked about time and time again, are resilient, do find ways to evolve and adapt to the current environment. One key takeaway, though, something to certainly monitor closely going forward. When we think about earnings, that is another phrase for corporate profits. Corporate profits are a function of revenue less expenses. That at the end of the day, what did you take in? What did you spend to generate? What's left over are your profits. Those profit figures have continued to grow. Interestingly enough, though, one of the trends we are seeing, revenue growth has slowed. We've seen more and more companies, though, really emphasize or incorporate some cost-cutting measures, being very diligent on their expenses. The translation there, they may not grow as quickly, but if you're then subtracting fewer expenses, your earnings can still maintain some positive momentum. Now, obviously, that is not a long-term strategy per se, but one that companies can, over the short and intermediate term, a strategy they can incorporate to obviously help smooth out and ensure they are, in fact, continuing to return that capital to investors. On a separate note, over the weekend, we had the 150th running of the Kentucky Derby. Interesting stat there, did not realize that is the longest active sporting event held in the United States. Congratulations to the winner there at an 18-1 payout. I know that certainly generated some nice returns for those folks keen enough to pick that horse. That's all for this week. As always, happy to discuss anything in more detail. If you don't connect, have a great rest of the week. Take care.